Mistakes made during the investment process can often be costly financially and cause quite a bit of heartache. You see, 7 years ago when I started investing, I did fairly well in the Singapore stock market and I was lured by the bright lights of the US stock market. It's volatile, my friends told me. You can make a lot of money, they said, and so without knowing anything, I dove headfirst into the US stock market. And let's just say, things didn't always go to plan. And so I set aside a sum of money that I was ready and willing for it to go to zero just to learn how to invest. And so in the process, I actually had my fair shares of wins and losses. I learned from my mistakes by reading about other investors who found themselves in similar positions and adjusted my strategy accordingly. And with markets hitting all-time highs after all-time highs, you may be tempted to start investing into the stock market purely out of FOMO. But the thing is, you are not exactly sure if you are ready to do so. Or perhaps you already have a sum of money invested and the truth is you actually just watch a couple of videos here and there, or maybe hear your friends say, hey, this one good, buy land, and then you just constructed your portfolio according to their recommendations, and you don't exactly know what you're doing. Because Warren Buffett likes to say, rule number 1 is not to lose any money, and rule number 2 is never forget rule number 1. So I'm going to point out to you 7 common mistakes that investors make along the way so that you can invest with a peace of mind and stay right to the end, because the last lesson actually cost me $20,000 to learn. And you see, the first mistake that investors make is trying to time the market. Now, the saying, right, time in the market beats timing the market is a cliche for a reason. You see, even if you're buying individual companies, right, you don't actually have to time the market. You have a range below which you are comfortable buying the company, and you keep buying as long as the price of the company is below that range. And once the company goes above that range, you stop buying, so you don't actually expect to catch the bottom of the company. All you need to do is just to review it on a regular basis and assess your buys based on the company's performance. However, buying index fund is much easier. Now, Charles Schwab recently did a study about timing the market, and what they did was they studied the investing styles of 5 different investors and looked at the results that each of their investing styles yielded. In this research, right, what happened was that each of these 5 investors were given $2,000 every single year to invest however they want. And so let's take a look at the results. Now, the first investor, his name was Peter, and basically he had perfect timing. Every single year after he received his $2,000, right, he would hold on to it and wait. Now, every single year as the S&P 500 moves, right, he would manage to buy right at the bottom, which means for that year, the moment that Peter buy, the stock market never go any lower. It only went up from there. Now, the second investor, Ashley, right, basically she boats up. At the start of the year, 1st January, when she received the money, 1st January, she invests into the stock market, and for the rest of the year, she doesn't think about it, she doesn't do anything about it, and that's all she ever does. The third investor, Matthew, he's a little bit more careful. So basically what he does, right, is every single year when he receives the $2,000 at the start of the year, he will break it down into 12 equal portions and dollar cost average on the 1st of every month into the stock market. Then our 4th investor, Rosie, wow, this one is the cui one, the super sway one, because unlike Peter, right, Peter every time buy is the bottom of the market and the stock market never went any lower. Rosie is the complete opposite. She takes the $2,000, she see Peter try, she also try and time, but she's always a little bit later than Peter. So every time Rosie buys the market, it is the top of the market for that year. And we come to our 5th investor, Larry. Larry basically just take the $2,000 and he put into T-bills every single year. So let's take a look at the results. Naturally, right, actually Peter performed the best. He made a total of $138,000 over the span of 20 years. You may be asking me, what? I thought you just told me not to time the market. But down here, basically the evidence is showing me that timing the market actually performs the best. You see, what we described was for Peter to time the market accurately every single year, which means out of 365 days a year, you have to find that 1 minute in the market where the market is the lowest and buy. Chances are that will not happen for you. And so this is hard enough to do for 1 year, let alone 20 consecutive years in a row. And in second place, we actually have Ashley, who just invested the money at the start of the year and she don't care about the investment for the rest of the year. She made a total of $127,000, which is very close to Matthew, who made $124,000, which Matthew's style is basically to dollar cost average into the stock market over the whole year. And the reason why we see Ashley actually performing better than Matthew is because actually 75% of the time the stock market is actually going up. Only 25% of the time do we see the stock market come crashing down and we have a bear market, which actually means the best time to start investing is now. However, people may choose to dollar cost average instead of lump sum investing because it actually helps to smoothen out the volatility. It gives you a peace of mind without much sacrifice in terms of your return. And I think the most comforting one is actually to look at our 4th place. 4th place is actually Rosie. Even with super cui timing, right, even though she's super sway, she still ended up with $112,000 over the period of 20 years. And actually the worst performing asset is actually Larry. When he invested in T-bills over the 20 years, he actually only made $43,000. It's having poor timing, buying the market right at the top every single year over 20 years, you're still 3 times better off than people who put their money into fixed deposits and T-bills. And so the takeaway is this. You see, it's basically impossible for anyone to consistently time the market, especially over 20 years. Even the big investors that we know of don't try to time the market. It is hard enough for anyone to try and time the market on any given year, let alone for 20 consecutive years. So you see, Peter's returns are purely hypothetical, which means that the next best thing to do is to start investing today. And all you need to decide on is how you want to invest your money, whether lump sum investing or dollar cost averaging. However, if you ask me, I would actually prefer dollar cost averaging over lump sum investing, despite lump sum investing on paper looks like it performs better for the very simple reason. When you do lump sum investing, you need to be able to stomach a high amount of volatility. However, when you dollar cost average, you actually smooth out the volatility, which actually means that you can invest with a peace of mind and you actually have some cash on hand in case of emergencies. So a very quick bonus point, because I literally just thought about this, right, is that a lot of times investors try to time the market because they are trying to beat historical returns. However, we have to remember when we invest, we are not trying to beat historical returns. We're not trying to do a lot better than the next investors. All we are doing is competing against ourselves, which means that we have to have a retirement goal in mind, and basically we invest to beat inflation in order for us to reach that goal. Because you see, if you are always comparing to historical rates, right, the T-bills today seem very attractive because in the past T-bills always return 1%, 1.5, 1.2%, or sometimes even 0.7%. So today's returns at 3.2, 3.5% seem very attractive when we are comparing to historical rates. However, when we understand how the economy works, how inflation actually works, we know that getting T-bills at 3.2, 3.5% today is basically just matching or just under inflation, and it's not actually helping you build your retirement portfolio. So another common mistake made by investors is to be too overly attached to the share price. You see, let's take Tesla stock for example, and let's consider these 3 investors, Xiao Ming, Xiao Hong, and Xiao Huang. Now, Xiao Ming probably bought Tesla back in 2019 for about $11 a share. Xiao Hong bought Tesla sometime last year for $290, and Xiao Huang bought Tesla just a couple of months ago for $138. Now, today the share price of Tesla is at $182. So does it mean that Xiao Ming and Xiao Huang should sell the stock now because they are in profit, and then Xiao Hong should hold the stock because he's making a loss? When I put it that way, it doesn't seem to make sense, but that is often what we end up doing. We make buy and sell decisions based on the price of the company. However, the truth is buying and selling decisions should be made based on the performance of the company and not the price of the company. You see, if you really truly believe that you actually found a good company, there is usually a price range for you to buy the company, and in that price range, it always becomes a good deal if you hold the company for a long enough time horizon. You see, if you were to take Apple as an example, when you're buying Apple back in 2011, 2012, it doesn't matter whether or not you're paying $50, $60, or even $70 for the stock, because today it is worth over $200. And one misconception when it comes to share price is that people are always very excited to average down. However, when it comes to averaging up, people are usually a bit more hesitant. But just think about this with me for a minute. If you are buying a stock that you're always averaging down, that means that over the next 5 to 10 years, you expect to average down your cost price until a very low cost basis. That actually doesn't make sense, right? If you're buying good quality companies, the share price should go up over time. And what you actually need to do is to track the company performance and to decide whether or not the performance of the company basically merits the increase in share price, and to feel comfortable with averaging up. Because if you buy good quality companies, you should expect the share price to go up over time. So averaging up is not always a bad thing as long as you value the company and you follow how the company performs. And the third common mistake that investors make, right, is basically to over scrutinize every single detail. You see, when we invest in a company, right, what happens is that we see this ticker symbol, this bunch of letters, and this number on our screen, and we think that's all there is to it. However, the truth is we have to understand that what we are doing is buying a business, and when you run a business, you are bound to come upon tough times, which means that businesses will have times when they are doing very well, times when they are doing not so well. And the fact of the matter is it boils down to the ability of management to handle and to overcome all these adversities when it comes to business. As an investor, all we need to do is to understand whether or not these adversities are fatal to the core business of the company. Warren Buffett actually broke this down into 3 main components to consider before investing into the company. Basically, the first one is management, second is the future growth prospects of the economy and the sector, and third is the price that you pay. Warren Buffett always said that we have to focus on the important and the knowable, and right now the important thing is for you to smash the like button and to subscribe to this channel if you have gotten any value, and I will actually know whether or not you have done so. So thank you in advance, and back to the video. So how do we focus on management? In terms of management, I think there are 2 things to consider. Management management needs to be reliable and management needs to be aligned with shareholder interests, which means that every time management promises something, every time they actually say that they'll make a certain amount of money, a certain amount of profit, that we see that each and every quarter they deliver on their promises, they actually meet or beat expectations. And when it comes down to alignment, this is slightly more subjective, but basically a good way to gauge is to look at the proxy statements to see how the management are being compensated and whether or not their compensation are aligned with shareholder interests. For example, some of the companies that actually buy management actually only receives a certain amount of compensation after the share price hits a certain amount by a certain date. So that way you know that whatever decision that management makes is basically to drive the share price in that direction, and which is basically something that is aligned with shareholder interests. So when you consider the future growth of the economy and the sector, basically what you're looking at is this thing called the total addressable market. Basically how big the market is for the service or the product that your company sells. So if you take Google for example, right, basically their main business is the advertisement. As long as Google is maintaining their share of the market, we can be sure that their revenue will keep increasing, which will then basically translate to a higher share price. And finally, the price you pay basically comes down to the valuation of the company, and this is something that you actually need to practice, looking at the different metrics of the company and understanding which metrics to use for which companies. And so another common mistake made by investors is to be overly diversified, because people always talk about diversification, but when you are new, you are actually not very sure how many stocks is diversified enough. I actually spoke a lot about this in my previous video, so I'll link it down here, but the truth is that if you actually know what you're doing, then diversification actually hurts your portfolio. You see, when I first started investing in the US market, right, I actually basically bought over 15 stocks. I held about 19 stocks at that point in time, and so basically, right, every single earnings season, I found myself having to track the earnings of 19 different companies. And so because my attention was spread out across so many different industries, across so many different companies, that I was not able to drill down and understand the details of each individual company. I finally decided to trim my portfolio down, and today I own somewhere between 5 to 7 stocks all the time, and I keep it within that number. So when something actually happens within the company, right, I'm able to understand whether or not it affects the core business of the company, or whether or not this is just some distraction and people are overreacting. And if I were to deem that people are overreacting, at least I'll be able to buy into the company, understanding the risks that are involved. The fifth mistake that many investors actually find themselves making is this thing called confirmation bias. Warren Buffett said we are really very good at finding new information that basically confirms our prior understanding of the company, of the business. And so every time we do research, right, we basically find new information to justify what we already believe or what we have already come to conclude previously, rather than interpreting new information objectively. And so for me, what I like to do, right, I like to go on websites like Seeking Alpha and things like that to read through different analyst report to get different analyst point of view. Especially if it's a stock I'm holding, I'll look at all the analysts with a sell rating and look at all the reasons that these analysts actually say that they would sell the stock, and see whether or not I agree with any one of them. And if I don't agree with them, then I can hold my stock, and if it's something that I agree with, then it's something that I will dig a little bit further to see whether or not there's some validity in that point, whether or not I want to consider selling that stock in future. And the next common investing mistake, right, is basically we don't understand how the tax structure and fees affect our investment returns. You see, there's this thing called withholding tax. So basically this means that as a Singaporean, when I buy stocks from the US or ETFs from the US, right, the dividends that are paid out are subject to a 30% withholding tax. And so when it comes to fees, right, we always need to pay attention to the expense ratio of the fund. And so basically this is the amount of money that it takes to run the fund. For ETF, usually this fee is actually quite low, somewhere around 0.05%. For a mutual fund, this might be slightly more, between 0.5 to 1%. Now, these numbers may seem very small, right, but over the span of 30 years, it actually adds up. So for example, a 0.7% difference between an ETF and a mutual fund could mean paying a fee of $1,800 or $15,000. Now, if I were to take $15,000 minus $1,800, the difference $13,200, and I have to invest it into a broad market index fund at an 8% return over 30 years, that will turn out to $132,000. But why do so many people still buy mutual funds, still buy index funds with such high expense ratio? And to me, there are three situations where the fees might make sense. I think the first situation is where the fees actually help me bridge a knowledge gap. So for me, my expertise is in Singapore and US markets. But when it comes to emerging markets, things like in India and Vietnam and things like that, that may not be my expertise. And if I want to get exposure to investing in that area, I'm okay to pay a fees to the mutual fund in order to get exposure to invest in that area. The second consideration is basically access to investment vehicles, because there are certain investment vehicles, right, they are not easily accessible to retail investors. If there are funds or institutions that make these kind of investment vehicles available to retail investors, then I may be okay to consider paying the fee. And I think the third consideration is the services provided. If you get access to analyst reports, to certain market data, once you start to invest in the fund, then I think it makes a bit more sense to pay the fee as well. But at the end of the day, I think the most important thing is not to dismiss the fees as it's just 0.5, it's just 1%, and it's not going to make a difference, because this small amount actually adds up over time. And the next common mistake that investors make, which basically cost me $20,000 to learn, learn is not having a plan. Now, I'm going to break this concept down of not having a plan into 3 parts: planning for emergency, planning for your investment goals, and planning an exit strategy. Now, planning for an emergency is the most straightforward. You just need to have an emergency fund, make sure your insurance is settled, make sure you have maximized your MediSave before you start investing, so that in case there's any unforeseen circumstances, you are not forced to liquidate your positions to meet some sort of financial obligations. When it comes to planning for your investment goals, right, there are 2 things to consider here. Firstly, your time horizon, and secondly, your stomach for volatility. Now, let's just be real here for a moment, okay? There's no way you're going to retire in your 40s and 50s just by putting your money into T-bills and fixed deposits. Now, but understanding your own investment goals and understanding your own stomach for volatility will basically help you pick suitable investment vehicles that basically balances the risk and reward, so that you can reach your investment goals at a suitable amount of time that is basically still within your time frame. Finally, when it comes to planning for an exit strategy, right, it's actually basically this. When we invest in index fund, right, it's quite straightforward. You want to invest it for the long term, 20 to 30 years. However, when you invest in individual companies, right, sometimes certain things change and you need to understand when to sell out of a certain company and to move into a better opportunity. So why did I call this my $20,000 lesson? I was holding on to this position for about 1.5 to 2 years, and over this period of time, right, this stock basically traded within a certain price range. And so basically after Nvidia reported their earnings, right, because this was an AI company that I was holding, the stock price actually shot up, and actually shot up 50% above where I bought it from. And at that point in time, I was actually considered another investment opportunity, and I wanted to take out some cash to put into this second investment opportunity. But because I was greedy, I actually thought that, you know what, it goes up 50% already, right? I'm just going to sell everything, and then I'll just buy it back when it falls back into the trading range again. But I never actually managed to buy back into my initial investment because it never actually went back into that trading range. And as fate would have it, from that point on, after making 50%, the company still went on to grow another 60% from there. And so because I actually liked the company, I was actually forced to basically average up and buy back at a higher cost. And the thing is, on reflection, right, if I were to actually make a plan earlier and to sell off a portion of the stock to fund my second investment idea and to leave the majority of my position intact, today that position will be up an extra $20,000. But because I ended up buying back in at a higher price, I missed out on this extra $20,000. So instead of having a planned exit strategy, I basically reacted to the price movement and made a mistake. And so the thing is, usually the biggest losses that we make in the stock market is not about the money that we actually lose, but the money that we never make. And once you have fully considered these 7 things, right, I actually talk about how you can allocate your portfolio to get you from $100,000 to $1 million over here, and I'll see you in the next video.